Welcome back to Real Talk with the Pros. I'm Tammy Halford, the associate broker here with Picket Fences Realty.
And I'm Chris McLaughlin. Today we're diving into part 2 of our series with Ray Logue of Loan Depot. And this one's a must listen to for veterans, current buyers, and sellers, basically anyone navigating the home buying maze.
We're debunking the myths around the VA loan process, what's changed, what hasn't, and what you really need to know. Plus, we're breaking down those confusing terms that pop up during a transaction. What does it all mean?
Pour your favorite drink, find a comfy spot, and let's dive into some real talk with Ray.
This week, we're going to talk about abbreviations and some things that are more detailed into the weeds with loans.
Sure.
What buyers hear, but may not always get an answer, and they just because we as realtors sometimes just throw it out there because we think everybody knows what we're talking about.
Sure.
So first one, DTI, debt to income ratio.
Okay.
Tell us about that.
So your debt to income ratio, and everything that I'm going to say is typically, right?
Mm-hmm.
You know, is typically calculated based off of your gross income.
Mm-hmm.
So the gross is what you actually make. If you make $100,000 a year, you don't get $100,000 a year. But we do calculate debt to income based off of gross. And each loan program has a different requirement for debt to income. And then sometimes they have kind of sub requirements, right? So they have their broad requirement. And then if you have a certain credit score or something like that, potentially that will tighten a little bit.
Mm-hmm.
But ultimately it is a calculation, again, typically based off of the debts that report to your credit bureau, right? So when I say that, there are debts such as your car insurance, your phone bill, your utilities, things like that. Those debts are not calculated in your debt to income ratio. The ones that we see that would be car loans, student loans, credit cards. We do see, recently, I feel like we see a lot more of these afterpays and affirms and things like that. And those don't always report to the credit bureau, but during the loan process, they typically rear their heads because of when we get a bank statement, we'll review it and see that you're regularly paying.
Oh, what's this?
Affirm, right. And we'll question that, and there's a solid possibility that will be included in there. Something else that's not on the credit report that would be included in your debt to income would be child support or alimony or something like that. But I mean, those are the big ones that we see. So, and certain loan programs let you go up into the 50s on percentages.
Okay.
And then even the VA loan doesn't have a hard cap, but they do obviously look at the entire scenario. But there may be a situation where a VA loan even would get approved with a higher debt to income than some of the other ones. Like FHA's hard cap is, I think, 56.99. And then with debt to income, you have what's called a front end ratio and a back end ratio. Okay. So your front end is your housing payment only.
Okay.
And that would be your taxes, insurance, PMI, and mortgage payment.
Okay.
And that's put against your income, and there's a number, and let's say that number works out to be 25. Okay. And then by the time we add in your other debts, your back end ratio is, let's say, 48, right? So your ratios would be 25, 48. But nonetheless, I mean, that is how the debt to income is calculated. And I do think that there's a lot of myths around that because people, a lot of times, I think a lot of loan programs allow you a higher debt to income than what a lot of people would think. Right. Again, though, I mean, they look at your entire scenario. They look at your money in the bank. They look at your credit score. There are things that are involved in squeezing those higher debt to income ratios.
You're an open book.
Right, yes. And so we work on it and try to be sure that it fits within the parameters. And we do have some automated help as well, right? Because there's AUS, which is automated underwriting systems. And so we can run your loan through that and it will either approve or deny it. And it will decide within those parameters if it's okay or not. And then I mentioned that sometimes if you have like a lower score or something like that, let's say it's something that we aren't getting an approval here, we can still look at the loan as a manual underwrite. And that one is going to be a little tighter. You know, I think FHA, depending on the situation, is anywhere between 41 to 45% on a manual underwrite, where a automated underwrite might approve it up to 56.99, right? So, but we don't have that ability on the manual side. So, anyway.
So let me ask this one question. Is this the reason why realtors tell their buyers don't go out and buy a house full of furniture, don't go out and buy a new car right now? Is that somewhere down the line in the loan process?
Well, definitely that has a big impact, because if we've looked at it and we pre-approved you with a certain debt to income, and then you change that debt to income, right, because of the things that you said, I mean, we might have pre-approved you to the max that you could get approved for.
Right.
Well, changing that all of a sudden can turn that approval to a denial. So it's not a great idea to, add debt after the pre-approval. And sometimes you can do it, and sometimes it doesn't impact anything. But at minimum, you're going to have to document it, right? So you're going to have to provide us with all the paperwork from the new debt that you received, get that to us. So there will be an amount of hassle, even if it doesn't affect
it.
Yeah, we're still going to have to ask you for more.
Gotcha.
And I mean, sometimes it could be silly, right? Because underwriters want truthful information. And what I'm saying by that is they want their income to be calculated to the dollar. They want your debts to be calculated to the dollar. So even if you go out and you get something that's very, very small, and common sense would tell them this very, very small is not going to impact your approval, that makes no difference, right? So it's tough for me to tell a doctor, hey, you went out and got a Kohl's card, and now I need all of that information, even though you're making $35,000 a month. I need clear documentation on this new debt that you got, that is a $25 payment. If the underwriter had their ability to just say okay, they would, but they don't, right? So we have to document that, even if it's silly.
Minimal. Right.
Another one we hear is the LTV, the loan to value ratio.
Sure.
And could you break that down and how that would be for buyers' financial options and stuff?
So the things we're talking about so far, they're all kind of some of the biggest points that we look at in decision making, right? Your debt to income, your loan to value, assets, things like that. But your loan to value is the amount of money that you're putting down. And if it's a $100,000 house and we can approve you at 96.5% loan to value, that means that you need $3,500.
Right.
And there are two calculations with the loan to value. You have, well, there's actually a few, but the primary ones are loan to value and cumulative loan to value. And so the CLTV, and the loan to value is your first, right? Your 96.5. But if I give you a second mortgage to help you cover some of your down payment, then that goes into your CLTV. And so that's also heavily considered, right? Because now they're like, well, this isn't money that they've saved up to put down. They're getting an additional loan in order to cover their down payment. So the biggest probably thing that we hear about, or why someone might start to question me on like loan to value, is, let's say you sell them a house for $100,000 and it comes in for $110,000.
Right.
Well, we still work off that $100,000, right? We use purchase price or appraised value, whichever is less.
Right.
Right. So if it appraises for $110,000, you still are required to calculate all of your to values off of that $100,000. And same the other way. If it comes in at 90, we're going to use the 90 and calculate it off of that, right?
So it's
So
less.
we are going to use your appraised value or purchase price, whichever is less.
So the cumulative you were talking about, is that also when you need to roll in closing costs, or is that, how does that work in there?
No, so
That's separate?
that is separate. And the way that's looked at is ultimately they would be like a seller credit or a seller paid closing cost. Well, that only works if the seller is selling you the house at slightly less than what it's appraised for. I don't know if I said that exactly right, but
Right, okay.
what I'm trying to say is, if I buy the house for 100,000 and I need 6,000 back for closing, that house still has to appraise for 100,000 in order for you to give me the 6,000 back at closing, right?
Gotcha.
You can't give me something that you don't have.
have. Right.
So when we ask you for a seller credit, that means the equity is there and the appraised value is going to show that the equity is there, and you're still going to give me the credit out of that equity. So for example, 100,000, $6,000 back, you as a seller technically are only going to get 94,000, right? Because the extra 6 is going to the buyer.
Gotcha.
And so no, that's not considered because
Okay.
it's kind of just an enticement from the seller.
Gotcha. Okay. Now let's get into the PMI.
Okay.
Private mortgage insurance. Explain that. How does it work? It always has the stigma of being bad. And also with the PMI, do you have to carry it through the whole entire loan period, or can it be stopped at some point?
Okay. So PMI is private mortgage insurance, and it is when you put down less than 20% of your loan. It does have a stigma because it is an extra fee that you're paying because you didn't have the amount of money needed to get you to that 80%. So it's sort of an insurance that doesn't protect you, it protects the bank.
Of course.
Right? So ultimately, you're paying for an insurance for the bank to be insured because they're lending you more than they feel comfortable with, and in order to do that,
They're covering their risk.
Right, exactly. And so PMI is not always expensive though. And a lot of times I'll try to explain that to people because, I'll have somebody come in and they do have a really good credit situation and they've saved up a really good down payment, and they're like, I want to put the 20% down because I don't want to pay this PMI. And that person, sometimes if I show them, hey, like, let's look at this with 10% down, because PMI it's scaled based on the amount that you put down. So if you put 10% down versus somebody that puts 3% down, you're going to pay less PMI just naturally. And then also, if you have a great credit score, you're going to pay less PMI than someone with a poor credit score. So when you think of that, the person I just described, he's got the great down payment, likely also has a fantastic credit score. And so their PMI might be extremely minimal. I mean, depending on, it's calculated off a loan amount, but on that $100,000 loan, it might be $40 to $50 or something like that a month, and it does fall off once you have achieved your 20% value or 20% equity. And so there's a little bit more to that piece of it too, because most loan documents say it'll fall off at 78%. But you can call and request it off at 80%, right? So it doesn't fall off instantly without you calling in and doing more to get it off at the 80%, but it will fall off at the 78.
So one more question. Does PMI have their own underwriters, or is it the same underwriters as a Loan Depot, or?
So they do. They have their own underwriters, but like a lot of companies like Loan Depot, we're delegated, so they accept our underwriting.
Okay.
But they do have their own underwriters, and we can send to a PMI company and ask them to review it if there's something we have question on. But if we're okay with it, and then they're typically okay with it too.
Okay. I just wondered because you have to go through 2 underwriting processes, 2 different companies.
Right. So not normally.
Gotcha.
Most of the time, it will follow the original underwriter that's underwriting for Fannie or Freddie.
Got it.
All right, let's talk about closing costs. What are the typical fees that are included in that, and could you break them down?
Right, sure. So closing costs, I mean, I always think of anything that you need in order to close your loan, right? So for me, it would be any fees that you have, but I would also lump together when I'm talking to someone their like their prepaid items, right? Which would be setting up their escrow account. They have to pay their first year homeowners insurance, things like that. Um, and then closing costs can be based on, the credit quality as well, right? Someone with a lower score or lower situation, they may have to pay a little bit as far as like a point or something like that to make that transaction happen that somebody who has fantastic credit would not have to pay. And oftentimes, I think in our market with us, I mean, depending on the loan amount, and maybe 6,500 should cover almost everything up to a $200,000 purchase price. That's a ballpark, right? And in my mind, that's covering your first year of reasonable homeowners insurance, setting up your escrow account, and then also your closing costs, which would consist of, your underwriting fee, processing fee, appraisal fees, your attorney fees, the deed search. All of those things would fall into that number, definitely give or take.
Right, even if you're including a home warranty in it as well.
So the home warranty is not something that the lender normally sees or works through. Oftentimes that home warranty is a lot of times paid for by the seller.
Okay.
So we don't even see it. So no, it would not be included in that very rough estimate that I gave you.
All right.
If a buyer were to buy points to lower their interest rate, can you go over what that looks like?
So ultimately, they're going to qualify for a rate, and that rate, let's say it doesn't have points, and and say it's 6.5, and they're like, what if I pay a point? Then I'll go in and look at the rate sheet and say, okay, 1 point would get you approximately 6.25, and they're like, well, what's that 1 point cost me? And it's ultimately 1% of your loan amount, right? So if your loan amount is $200,000, then it is $2,000 to cover that point. So, I mean, I think that's...
Is it beneficial, do you think?
So,
what's your opinion?
I think that it is a gamble, right? I think that the bank is gambling one way and the buyer is gambling another, because ultimately you're paying $2,000 to lower your monthly payment by, let's say, $40. Well, you take that $40 and you divide it into the 2,000, and you can come up with the amount of months it would take you to recoup that, right?
Right.
And
I know. I don't do math on the fly either. But I was just curious if it's, because I do have clients that do that, and I just wondered, is it beneficial?
So sometimes once you do the math, you end up with, it takes 24 months to get it back. So you just need to look at the situation and say, hey, do I think I'm still going to have this loan in 24 months? Right. Do I think I'm going to live in this house in 24 months? Do I think the interest rates are going to come down where I want to refinance in the next 24 months? Because if 24 months is your number and you pay it off in 12 months by either selling it or by you're refinancing it or something like that, you've ultimately left money on the table, right? It cost you more to buy that point than you saved during your time that you had the mortgage. So that's where it would be a negative. And then, if you're like, I don't think rates are going anywhere and I think I'm going to live here forever, and you pay those points and you do, and you're there, it took you 24 months to recoup it, and 10 years later, you're still making a payment on that mortgage,
right?
Then you did well, right?
So it's a case-by-case basis, yeah, for
1,000% case by case.
Gotcha. So I guess we're going to talk about amortization now. Chris, what do you think about
it's one of the terms that it really sounds complicated. Yeah. And can you walk us through what it means and how it affects your monthly payments?
So, I mean, the amortization, it is a schedule, right? So ultimately, when you have a 360-month loan, if you print an amortization schedule, that first page is very, very depressing, because it is going to tell you how much of your monthly payment is going towards principal, and how much of your monthly payment is going
What did I get
towards
myself into?
interest, right? And it's a very rough document to look at, and it's also, most of them calculate the number for you, and you'll see what your total payments were for that $200,000 loan. And again, very, very upsetting. But you have to have some place to live, and you're going to rent, which is effectively 100% interest, right? Or you're going to pay all of that money and have no principal given back to you in 30 years. You have no ownership of that property. So given the alternative, even though it's a rough document and a rough thing to look at, the amortization, and I've never looked at one for myself because I don't need that sort of blow. Right. I just know, show me the last page where I need to sign.
Yes.
And that last page doesn't look as bad. So, but it's a bunch of pages.
2042.
That's why I always say with my parents and stuff, I know we had mentioned it prior about making extra payments and stuff. That's why, to take off the equity.
And it does. I mean, making extra payments makes a huge difference on your overall payback, because, I mean, it just lowers it. And you can take, I mean, the biweekly payments, again, they depend on your interest rate. But, I mean, I've seen examples where they're taking 6, 7, 8 years off just by making that extra mortgage payment per year. And that's huge.
Yeah.
So what I like to do when we're at the closing table, I tell my clients, my buyers, on the anniversary of your purchase, if you could pay one extra payment at that time, then, this is what you're going to recoup. So
Right. And that would be the same as making a biweekly payment, right? Because when you make a biweekly payment, you end up making 13 full payments per year.
Right.
So what you're saying would be very, very similar to making an extra payment per year just on the anniversary.
Right. So,
but sometimes it's a lot easier for people to make those biweekly payments because they already are used to it coming out of their paycheck anyway. So that off month where you get 3 paydays and you pay that extra, it's a whole lot easier.
Sure. Well, that's a good point too. So the closing document.
Closing disclosure.
Yeah, the closing disclosure that needs to go to all parties before closing, and then talk about the closing document that they actually get the day of that they sign. Kind of go over what those all entail.
So, I mean, the closing disclosure, at that point, when it comes out, a lot of your fees have already been determined and set. I mean, you have a loan estimate, and if there's changes along the way, you will get updated loan estimates. But, once your closing disclosure comes out, it's a little more accurate, right? Because there's been more time in your processing of your loan to know what would need to go on there from a standpoint of, I mean, little things like maybe you have to pay off a little credit card to qualify. Well, that would likely make that closing disclosure. We do have to get you the closing disclosure 3 days prior to closing. And there are certain things that are not allowed to change at that time. And if they are allowed to change, it starts a new clock, right? A new 3 days. But so typically when you get your preliminary closing disclosure, it's not the exact number that you want to run out and get your cashier's check for, but it's very, very close. And, but I feel like at least with us and today's, like the way the requirements are, you've seen those numbers so many times before that preliminary closing disclosure.
It's not a surprise.
It shouldn't be, no. And then
shouldn't be, right?
And if anything changes that's allowed to change, it still probably will set a new clock, and you have to have 3 more days before closing. But it gets you there. And normally closing disclosures go out while the loan is being finished up in underwriting. And then after that, it goes to our closing department, and the closing department basically really like tallies everything up and fixes, maybe you had a homeowner's insurance quote, right? Well, now we have your actual homeowner's insurance. And let's say that changed by, $25. I mean, that's now fixed and put on the final closing disclosure.
Then you got some prorated items too.
Right. And those all get ironed out once the closing department and the attorney really start working together to finalize that, to come up with the final figures. But they should be pretty close.
Okay. So now we're going to switch gears a little bit.
Mm-hmm.
We're going to talk about the veterans loans,
Okay.
the VA loans.
Cool. One of my favorites.
Yeah.
It is.
Okay, well, we'll get into that. So, have you ever watched the show called Mythbusters?
I don't know that I've watched it, but I feel like I could.
You know about it?
Maybe.
They take myths and kind of prove them wrong physically by doing whatever the myth is. But we're going to play a little game with VA and bust some myths with them. I have my first question. Truth or myth?
Okay.
VA loans require a down payment.
Myth.
And why is that? Why has that myth been around for so long? And I mean, do you have any?
I don't know, because it's one of the biggest benefits of the VA loan is the VA loan does not require a down payment, and it also doesn't have the monthly mortgage insurance that you talked about earlier.
Mm-hmm.
So you are able to get 100% financing, and if you are fortunate enough to get the seller to pay your closing costs for you, there's a very solid possibility that when you come to closing, you will not have to bring a check, which is huge. I mean, you're buying a house and you're not having to bring a check. You know, there are things along the way, sometimes the appraisal fee or something like that. But at the end of the day, at the actual closing, there is not a down payment required. Now, I told you that sometimes we can use like our automated systems.
Mm-hmm.
Occasionally, they will be more approvable
Mm-hmm.
if we show a small down payment, even with the VA loan, right? So even though it's not required, it might, if your situation is not great, having a small down payment might make your chances of becoming approved better.
A lot better.
But typically, no. I mean, no down payments required. And occasionally we'll have people who want to put a down payment, and that's great. And so it is accepted. But most times it's you just don't have to do it.
All right. Second
Myth
question
going
for
down.
truth and myth. The VA appraisal is a nightmare and takes way too long.
So where's the middle button? Right? Where's that one? I'm going to say myth because you said the VA appraisal is a nightmare and takes way too long. All appraisals at times can be a nightmare and can take way too long. I don't know that I think that I would say that the VA appraisal is worse, but there are limited VA appraisers.
Wow.
And so that anytime you limit your bucket of people that you have to choose from, that's going to make it a little harder. And the VA, we order the appraisal through the VA, and they place it, so we don't have as much information about where that's going at all. And so be difficult, sometimes in a market if you have an appraiser that just never turns in their work or, is just very, very difficult or argumentative when we ask them a question or something like that. We would have the right to no longer include that person in our rotations, right? We will just, as long as we have enough people on our panel, then we just wouldn't use that person. But with the VA, we don't get that opportunity. But I don't think they're any more of a nightmare. If I were selling my house today and I had a VA loan put in front of me or a conventional loan, I don't know that loan type would be what I would be worried about. And I mean, the VA loan, to me, it is an easier Loan to get than that conventional loan, which means the likelihood of something popping up maybe could be less likely with the VA loan, because even if something does pop up, the parameters may allow it to still move forward, where conventional, if something pops up, the parameters may not allow it to move forward. So
yeah, so that stigma has been around. I mean, because if you get a multiple offer situation, you have a conventional, you have a USD, and you have a VA. It's like, the VAs are not going to be chosen because they've had this stigma,
right?
Of being a bad opportunity.
If you're selling a newer home, then that would even be less of a concern. If it's an older home, traditionally conventional appraisals are lighter from repairs than the government backed loans like VA, USDA, and FHA. But in my experience and what I've seen happen over the years, I think that conventional has gotten tighter, and I do think that the government products have kind of loosened those harder repairs. What I see now is kind of easy repairs to do. You know, you're talking GFCIs or handrails, those types of things that, yeah, maybe the conventional appraiser would not call, but anything that's more stringent than that, the safety, it's going to get called on conventional these days, right? I mean, if there's mold or something,
sure,
you're going to get called on either product.
Yeah, because you don't want someone going in breathing.
Yeah.
In. Yeah.
So I would say that it's a myth in the fact that, I mean, most of our VA appraisals go just fine, and if it doesn't, I mean, there's other options too sometimes to work through it, like a renovation loan or something like that attaches to the VA.
Except maybe in Pittsburgh, where you walk into all those houses and they look like Pittsburgh's dad's house.
Yes.
The 70s rug still on the floor.
No, we don't mind dated. Dated's absolutely fine. Ugly closes all day long. Because I have people call me and they're like, hey, can I get a loan on this? Now it needs renovated. And I'm like, describe renovated. Is it functional or is it ugly? Because if it's ugly,
all day long.
All day long, right? If it's not functional, right? If they've ripped out the bathroom or it has no floor, things like that. Right. No septic, that kind of stuff. Those things are going to cause a problem on any loan program.
Yeah.
All right, so myth 2 busted. Okay, let's go for 3. Only combat veterans are eligible for the VA loan.
No, myth. There are some stipulations for you to be, eligible for it. And I would say that most people I work with that I talk to, they know whether they are or are not. I don't know, eligible or not. It's not typically a situation where I find somebody that thinks they're not eligible and then we determine that they are. We do have people that are like, well, we don't know. And then a lot of times we find out they're not eligible. But there are some like days of service that are looked at. And I think it's 90 days of active like duty during wartime. And then 181 days of duty during peacetime. I think are the big things that determine whether or not you are eligible for the VA. But I don't know. Those things are tough. I always have to look them up, but it's a very easy process on my end to determine, because we just request your certificate of eligibility, and that tells us oftentimes, I mean, it should tell us whether you qualify or not. But, somebody thinks they do and they don't, then I'm going to work through that with them and say, okay, let's dig a little deeper, because any document could be wrong, right? So there's a chance that it's not accurate, and we would have to work through that to get it updated. But most people know if they're eligible or not, but you do not have to be a wartime, I forget exactly what you said, but
a combat veteran.
Yeah, no, that's not necessary.
Very good.
All right, 4th question, true or myth? You can only use your VA loan once.
That's also a myth. So not only can you use it more than once, you can have more than one VA loan at one time. Now there's a certain amount of eligibility that every veteran gets, and so you would have to be within that eligibility to have 2 or 1. But there are situations where you could have 2 VA loans at one time, or you could also use it multiple times. I mean, I know that I have never crossed anybody that's reached any sort of limit, so I'm going to say it is unlimited, and that you can just keep on, I mean, if you keep on buying and selling, we would keep on doing those loans for you.
All right. Our last one, VA loans come with higher interest rates.
No, the VA loan actually is typically the interest rate is better than market rate. And again, with no PMI, if you could put zero money down, have a better than market rate, so your ultimate payment could be massively reduced versus somebody who is not a veteran and ends up having to get a loan with no down payment with, you know, the market rate and PMI, right? So it could really be much, much cheaper.
Very cool.
Well, that is awesome for, you know, busting those myths for us.
Right.
So I think a lot of
You guys need,
listeners
like,
will
a
have a
hammer.
new outlook on
Yeah, we
that.
should have.
Right. There should be some sort of like boom or
Boom.
pow.
But how do the VA
Effects.
loans and how they really work is definitely, you know, the listeners will be, you know, because I've heard a lot of these myths as well, and not knowing, you know, I've never looked into.
It's a fantastic loan.
Yeah.
That's all I can tell you and I mean, I'm the loan officer side of it, right? I'm not even the veteran getting the benefit of it. But from the lending side, it's not a difficult loan for us to process. And it actually opens up the door for so many veterans to qualify, because maybe they maybe they haven't saved up the down payment, and maybe they don't qualify for some of the other programs that we have that would, you know, require no down payment, and this one might be perfect for them.
So, like Chris said, we appreciate you coming in today and busting some myths and just getting into some of the big jargon words that are thrown around during loan times. But is there anything about VA loans or any terms that we may have missed? But I know you keep saying, if it were me, it'd be a VA loan. I just, can you expand upon why? I mean, because that is something we don't see, you know. It's, let's put VA loan and then the rest, you know.
Sure. So the reason why I like VA loans is because it's one of my tools, right? It's a tool that I have to get a client buyer to the closing table. Well, in my opinion, that is my best tool, because they have flexible guidelines, right? They don't require down payment, right? So that's a huge tool right there, because if somebody requires a down payment and they don't qualify for any of the loans that don't require down payment, then I have nothing for them. But if they were a veteran, I would. Assets are something that are always difficult to verify. Not always. Some people just keep them in their bank account, but some people keep them in their mattress, and some people
coffee cans up on the tree, buried in the ground.
Some people take it out of the bank and give it to their grandmother to hold it under her mattress. Right. So it's just, and with VA, with no down payment needed, I might not need to verify assets, right? So again, it makes that one a little bit easier. They're oftentimes a little more understanding with the credit situation, right? If there's something that's kind of gone awry, especially, and I think we touched on this last time, especially if you've straightened your credit up, right? If you have, you've had some mistakes and now you're on a better path, and a proven path, right? Something that's, we can see 12 months history. I just feel that loan is also going to be very, very beneficial. Now, I mean, I do love a good conventional loan as well, right? Because it sometimes is easy, and a lot of times it's the very vanilla clients. And nobody wants to be vanilla except for when it's financing, right? Because you want to be
or ice cream.
Right. You want to be plain as can be in financing, right? Like, you don't want the any sort of features, right? Because oftentimes when you add features, you are adding like maybe extra costs, more fees, more risk. But I don't, the VA loan has all those features, and it doesn't have all those bumps along the way.
Well, that makes sense of why it feels more that you lean towards that loan.
Right. And I also feel like, why would, it's a veteran, right? And so why wouldn't we want to help?
Absolutely.
So for me, I would think it would make me feel better to side with that type of loan as well, because of
the service that they've given to us. Yes.
But I certainly wouldn't want to feel that that's why I didn't do it. Right. So it's I don't know if I'm looking at the multiple loans.
6, 7,
Right.
6, 7.
Right. Exactly. I still don't know what that means exactly.
Sounds good.
Right. But so in my opinion, the VA loan is just a fantastic loan for the buyer, and when it's fantastic for the buyer, it's fantastic for the seller. There are just so many flexible pieces to it, and when we're doing that financing together and we have all the flexible parts, it just makes things easier.
So last time we were here, I'm sorry, I keep interrupting.
That's all right. That's all right.
Right.
This
is her party.
I'm still wondering why.
She just invited
You
us.
all
to
invited to the party.
This.
From the last time you were here last week to this week, we've dropped 1/4 of a point. Do you see any more coming?
So
And how recent? I mean, how
with the interest
in
rates?
future? Yes.
So our rates have not been as impacted as what we might feel. And typically the mortgage interest rates they predict what's happening. And so our rates will oftentimes go down prior to when you see the rate cuts, right? And so we anticipate that. And then sometimes they'll anticipate, let's say, for example, the mortgage market anticipates a 0.5% rate cut, and then there's a meeting and it drops 1/4. Well, that day I'm getting calls because everyone says, hey, I heard rates went down. And the reality is I'm looking at my interest rates and they went up because they anticipated a 1/2.
So they had to make up.
And the 1/4 only happened. So therefore there's an adjustment, right? But this time I did not feel it as much. I didn't even see the anticipatory rate drops. I mean, a little bit, but not much. But in our world, 1/4 movement, I mean, because the rates move every day anyway.
Not big of a deal.
An 1/8 or something. I don't know. It just doesn't always seem like we see it in the way that you would feel or a buyer might feel that we would see the interest rates dropping.
Well, Ray, we appreciate you being here today. Is there anything that you haven't mentioned today you'd like to say, or anything you want to talk about on this subject? Because we want to have you back to talk about the other government loans. So
Nope.
This is your time to speak.
No, I'm good. I feel like we've said a lot, and I really appreciate you having me. And thank you, and I look forward to next time.
All right, thank you. And that's a wrap on this episode of Real Talk with the Pros. Huge thank you to Ray Logue from the Loan Depot for joining us again and helping us get through the process and all the noise with VA loans.
From busting myths to breaking down the loan process step by step, Ray brought the clarity and insight our listeners needed. Whether you're buying your first home or you're just trying to make sense of the mortgage lingo.
If you're a veteran, active duty service member, or a surviving spouse, we hope this episode can give you some clarity and confidence to explore your home ownership options. The VA loan is a powerful benefit and tool, and now, with the 2025 updates, it's more accessible than ever.
So don't forget to subscribe, share this episode with someone who needs to hear it, and check out our show notes for links to resources and more info on everything that we covered today.
Until next time, keep asking questions, keep learning, and as always, stay real.